Every day, more and more people are investing in the stock market. They're buying things they don't understand, and most importantly, they're investing in things they don't understand how it's going to create any sort of income or profit. This is exactly what I did when I first started investing, and I got bored very quickly and panic sold as soon as stuff started to go negative. I didn't have any sort of strategy or vision or any sort of long-term charisma to my investment approach, and it made me reflect over the past year where I built up a portfolio of just under £13,000 with a profit of about £1,000, and it made me realise what I could have done differently had I invested smarter and better. So if I went back in time and I started with £1,000, this is how I would spend it. And no, it's not the YTA method, please don't do that. So, starting off, if I had no experience and was new to investing, I would invest in a broad market index fund. So for those of you who don't know, an index fund is a financial instrument that tracks a specific set of investments. So the most popular is the S&P 500, which is a index fund, a list of companies of the biggest 500 companies in the US market. So this includes companies like Apple, Microsoft, Johnson & Johnson, like literally 500 companies, and it's diversified across the whole market. So that means you've got all the pharmaceuticals, you've got the retail, you've got consumer goods. So if you buy this index, one unit of this index is automatically diversified across them 500 different companies, and you benefit from having the larger companies, the more stable and more prominent companies already established. You benefit from buying larger holdings in them, where your money is more secure and safer. Even though they might not be able to grow as much as the smaller companies with more potential, they have less risk and are more likely to pay consistent dividends that constantly get reinvested through this index fund. So on Trading 212, you can buy an index fund by going into the search option, clicking on ETFs, most popular, and you can find the top ETFs that Trading 212 has. So as I mentioned, the S&P 500 is right there at the top. And there are several reasons why I would be putting my money into this index fund. So as I mentioned, diversification. Secondly, is the historic performance of these index funds. So historically, over the past 100 years, the S&P 500 has returned annual results of 10%. So this is a phenomenal value, especially when you compare it to the alternative. If you're not investing your money and you don't know how to invest into individual companies and take more risks, the alternative is putting into a cash savings account, which currently is returning 0% interest rates. The highest I've seen in the UK market, I believe, is like 1% or something very, very low. And that even now is getting considered, and it's looking like it's going to be dropping even further. So 10% a year, where you have to put little effort and time and research into it, is phenomenal value for your money. So with that 10% over the 100 years, you've got to account for all the dips and downturns that the market has faced. So that includes the dot-com bubble, the 08 recession, and most recently the coronavirus pandemic, where you saw the stock market drop 30-40%. So with that average 10% over the years, if you're buying when it's at that dip, like I said more recently, the massive drop that the stock market has faced, if you invested there, you would benefit from buying at a lower price and still realising them 10% annual returns over the long run. So there was some research done on this, and if you had invested £200 a month starting 40 years ago, that £200 a month investment would have totaled up to £200,000 invested, and the value of that portfolio in this index fund would be worth 1.6 million. And like I said, that's with all those market dips. That's not accounting for any sort of time of the market or researching when to buy. That is just consistently putting £200 in a month in the market for the past 40 years. Your £200,000 investment would have been worth £1.6 million. So that's incredible amount of money. Like I said, when you think about it, you can put it away and just forget about it, which most people do anyway through their pension schemes at work, but it's just invested in things that aren't getting as good results. So index funds tend to perform better than actively managed funds. So if you're paying higher management fees for someone investing your money for you, it's still on average earning less than a broad market index fund would anyway. It's very, very hard to beat the market, which is what the S&P 500 tracks, which is the strongest market currently, the US market. Not only this is what the best value investor of our time recommends, Warren Buffett. He said if he went back in time and he had money and he didn't know about investing, he would just put money in a low-cost index fund continuously to benefit from the compounding interest that historically it has produced. So to conclude, if I was starting off with my £1,000 journey and I had £1,000 to invest, or even £100 or a few £1,000, it doesn't matter, obviously that's independent of yourself. If I had a relatively small amount of money and I didn't know anything about the stock market, I would invest in an index fund. This is because they are relatively safe, especially over the long term. This is what history suggests. And the key point is the length of time that you hold the investment for. The market does breathe in and out. It constantly fluctuates. It goes positive, negative all the time. Like I said, when I first started, I bought a mutual fund that I didn't really understand. A mutual fund, for those who don't know, is essentially a basket of funds that's managed by a portfolio manager. So you buy one unit of this mutual fund, and it's similar to the index fund. It has several different companies and assets underneath it, and you own a portion of each of them. So when I bought this, after a few weeks it went negative, and I thought, okay, obviously it's a rubbish fund, and then I sold, and then obviously the inevitable happened. After a few months it would have been in profit if I just held longer. So if you are going to invest and you've got money to invest, please do it with a long-term mindset, and the recommendation is do not invest any money that you're not willing to lose in the next 5 years, or not necessarily lose, but use the money in the next 5 years to allow for any market fluctuations. And over a 5-year period, you should see a better return, especially when you're comparing it to cash interest rates. So another point to conclude on is, if you are going to invest in these index funds, a highly recommended strategy is cost averaging. Like I said, the market does go up and down. So if you do have £1,000, it could be worth putting maybe £500 in it now, and then spreading out £100 payments monthly. So then you benefit from getting an average price, and you won't be paying too high of a price if it's at its peak and it drops lower. But then if it drops lower, you still have cash to jump in and average down. So thank you guys for watching. Please do let me know if you guys have recently just started your investment journey. If you haven't started yet and are looking for a brokerage, please use the link in the description. Myself and you both get a free share worth up to £100. So that's a brilliant way to start off your investment journey. And let me know if you're a bit further, how much of your portfolio you've allocated to index funds and other investments that you might have. So thanks for watching. I'll catch you guys next time.